morning's U.S. Bank Economic 360. With Europe dominating so much of the news lately, we've heard much less about China, the world's second largest economy behind the U.S. It appears that much change is coming, and that is likely to impact the U.S. and the rest of the world in major ways. We have an update now as we're joined by U.S. Bank investment analyst Jim Russell. So China is completely overhauling its economy. What does that mean here?
It's a great question, Brian. Good morning. What they're doing is really taking the economy and converting it completely. They're the world's largest exporter of goods. I think everybody in the United States is probably aware of that fact. They're going to turn the economy into a much more consumption-oriented economy. The Chinese economy functions much like our economy and much different than our economy at the same time. There are private elements of their economy, but by and large, the central authorities run that economy. What they have done is established a 5-year plan to double the wages of the people of China across the board, 1,300 million people. They're in the second year of that plan, goosing everybody's wages, call it 12 to 13% per year or so every year. What that has done, though, is perhaps made China not the low-cost producer, and that has kicked manufacturing jobs to South Korea, Taiwan, Singapore, and, of course, back to the United States. So good news on the job front there.
All right, so our economy has been slow. Is that the case in China?
The Chinese economy is indeed on the slow growth path. Let's take a look at maybe what the data says. What you see here on the graphic is a trend line of what the Chinese GDP growth rate has been over the last 10 years. Over to the right-hand side of that, you can see the data really falling off and collapsing down to about a 7% growth rate. Now, let me quickly say that our growth rate in the United States for the third quarter is 1.3%. For China, it's 7.4%. So they have slowed from a 10% growth rate to 7%. But it does indicate that transition from an export-driven economy to a consumption-led one is a little bit bumpy and still work to do there.
Is this influencing our markets?
It is influencing our markets to quite a huge extent, actually. Let's take another look at another graphic here, and what you'll see here is a comparison of the S&P 500 in red, the top line, and the Chinese market and the bottom line. I will quickly tell you that Europe is China's largest trading partner. Of course, we all know that Europe's in recession. They're not selling as many things to Europe at the very same time that the wage growth in China is starting to ramp up. That collapses margins and decreases profitability. That's exactly why the markets have not done well in China. We'll probably likely see that for a couple more years, but we're also thankful, frankly, with China slowing down, that's relieved pressure on commodity prices. It's one of the reasons why gasoline prices have dropped from $4 a gallon to about to about $3.40 or so, and we see that trend continuing.
Jim Russell, we appreciate you and U.S. Bank. Thank you.
Thank you, sir.